When you think of Swiss bankers, you probably picture secret vaults, hidden accounts, and billionaires stashing away fortunes. But here's the real question. How do these bankers, the very people trusted with the world's money, actually manage their own wealth? The answer might surprise you. Swiss bankers don't gamble on flashy trends or chase risky shortcuts. Instead, they follow timeless strategies that protect and grow their money quietly. Today, I'm breaking down the 5 key ways Swiss bankers invest their own money. Lessons anyone can use to build lasting wealth. If there's one rule Swiss bankers live by when it comes to investing their own money, it's this: never put all your eggs in one basket. Diversification is at the heart of their strategy, and it's easy to see why. Their entire professional world revolves around protecting client wealth, and that cautious mindset carries over to how they manage their personal finances too. Think about it. A Swiss banker wouldn't pour all their savings into a single stock, no matter how promising it looks. Instead, they spread investments across different asset classes: stocks, bonds, real estate, gold, and sometimes even alternative assets like art or private equity. The goal isn't to hit the jackpot with one risky bet. It's to make sure that if one area drops, others help balance things out. This mindset comes from Switzerland's long tradition of financial security. As a country, Switzerland has always positioned itself as a safe haven. That's not just for show. It's a philosophy deeply embedded in how bankers think about money. They'd rather grow wealth slowly across many categories than risk losing it all in one move. For example, a typical Swiss banker might have part of their money in global stock markets, but they'll also hold stable government bonds, invest in local or international real estate, and keep a portion in precious metals. This balance gives them protection from market swings. If stocks crash, real estate or gold often holds value. Even within categories, they diversify further. Instead of buying shares in just one company, they might spread across industries, regions, and currencies. That way, they're not overexposed to the risks of any single economy or market. It's not about being flashy or chasing trends. You won't see Swiss bankers bragging about buying into the latest meme stock or cryptocurrency hype. Instead, their approach is calculated, measured, and intentional. They want consistency, not chaos. The lesson here is clear. If you want to invest like a Swiss banker, spread your risk. Build a portfolio that has different types of assets, not just one. Don't bet everything on the hottest stock or the latest get-rich-quick scheme. Instead, think like a wealth protector. Someone who invests not just to grow money, but to keep it safe no matter what happens in the world. That's how Swiss bankers ensure their wealth remains steady, even when the markets don't. If you want to understand how Swiss bankers think, remember this. For them, protecting money is more important than multiplying it quickly. Safety always comes before risk. It's not that they never take chances, but every decision they make is carefully calculated with one goal in mind: preserve wealth first, grow it second. This cautious approach comes from centuries of Swiss banking tradition. Switzerland built its reputation by being the safest place in the world to store money. Bankers there became famous not for making clients rich overnight, but for ensuring their fortunes stayed secure through wars, crises, and market crashes. And when it comes to their personal money, they apply the same philosophy. Swiss bankers tend to favor conservative investments. That often means government bonds, blue-chip stocks, or diversified funds with a long track record of stability. They're not interested in gambling on penny stocks, chasing speculative bubbles, or putting their life savings into high volatility assets. For them, a steady 4 to 6% return over decades is far more appealing than the possibility of doubling money quickly but risking it all. This doesn't mean they avoid all growth opportunities. Many Swiss bankers do invest in equities, startups, or alternative assets, but they always do so with limits. A small portion of their portfolio may be allocated to higher risk opportunities, but the majority is kept in safer, more predictable investments. It's about balance, with safety always holding the larger share. Even their mindset toward debt shows this preference. Instead of leveraging heavily to boost returns, they often stay conservative, avoiding unnecessary borrowing and minimizing exposure to market swings. Where others might take on massive debt to buy property or chase investment gains, a Swiss banker would rather build wealth gradually and with less stress. What's powerful about this approach is that it works across generations. Wealth built cautiously tends to last. By avoiding risky bets, they protect themselves not just from losing money, but also from the stress and emotional roller coaster that comes with high-risk investing. The takeaway? If you want to think like a Swiss banker, stop obsessing over high-risk, high-reward plays. Focus first on safety, solid assets, long-term stability, and protecting what you already have. Growth will follow naturally, but the foundation must always be security. That's how Swiss bankers sleep well at night, and why their wealth endures. When it comes to building and protecting wealth, Swiss bankers understand something many investors overlook. Not all value is created equal. They know that markets can rise and fall, currencies can inflate or collapse, and digital assets can vanish with the click of a button. That's why they place such a strong emphasis on real, tangible assets, the kind of wealth you can actually hold, live in, or pass down physically. Real estate is the cornerstone. Property in Switzerland is famously expensive, but that hasn't stopped it from being one of the most trusted ways to preserve wealth. Unlike volatile stock markets, real estate offers stability, utility, and long-term appreciation. For many Swiss bankers, owning a home is only the beginning. They often invest in rental apartments, commercial buildings, or even farmland, both within Switzerland and abroad. This provides not only growth, but also consistent income streams, which further insulate them from financial instability. Gold is another pillar. Switzerland has been a global hub for gold refining and storage for centuries, so it makes sense that bankers here value it highly. For them, gold isn't about quick profit, it's about security. It acts as insurance against inflation, geopolitical turmoil, and market crashes. A portion of almost every wealthy Swiss portfolio is tied to precious metals, often stored in Switzerland's famous high-security vaults. Then there are alternative real assets. Many Swiss bankers diversify into fine art, rare watches, antiques, or other collectibles that retain value across generations. This isn't about showing off. It's about investing in scarcity. A painting by a known artist or a vintage Patek Philippe isn't just a luxury item. It's an asset with historical and financial significance. What makes this strategy so effective is balance. Real assets don't exist in isolation. They complement paper assets like stocks and bonds. When markets crash, real estate and gold often hold their ground. When inflation eats away at cash, property values and tangible goods typically rise. This blend ensures that no single event can wipe out wealth completely. For everyday people, the lesson is powerful. You don't need a Swiss vault or $1 million property portfolio to think like a banker. You can start small, buy a home instead of renting forever, hold a little gold or silver as insurance, or invest in items that combine utility with long-term durability. By grounding part of your wealth in things that are real, you create a financial safety net that lasts. Swiss bankers know that markets can be unpredictable, but a house you can live in or gold you can hold in your hand is wealth that endures. That's why real assets remain a cornerstone of their strategy. If there's one trait that defines Swiss bankers, it's patience. They don't look for shortcuts. They don't chase every new trend, and they don't panic when markets dip. Instead, they practice long-term discipline, a steady, deliberate approach to building wealth that focuses on decades rather than months. This mindset starts with how they view money itself. For many investors, wealth is about speed, doubling your money in a year, timing the market, or striking it rich with a lucky bet. But for Swiss bankers, wealth is about endurance. They ask, how can this money last not just through my lifetime, but through my children's and grandchildren's as well? That generational perspective makes them avoid reckless risks. Their portfolios reflect this philosophy. Instead of concentrating on short-term opportunities, they build diversified holdings designed to grow slowly but consistently. They invest in blue-chip companies with proven histories, government bonds that provide steady returns, and real assets that retain value. Over 20, 30, or 40 years, these seemingly boring investments outperform flashy trends that burn bright and crash hard. Another key element is emotional control. Market downturns are inevitable, but while many investors panic and sell at a loss, Swiss bankers see volatility as part of the process. They've trained themselves to think long-term, so a market crash isn't a catastrophe, it's often a buying opportunity. By staying calm and disciplined, they avoid the destructive cycle of fear and greed that traps so many others. Discipline also shows up in their savings habits. Consistency matters more than intensity. Rather than saving aggressively for a short time and then stopping, they build the habit of saving and investing steadily for life. A percentage of income goes into investments every month, no matter what. This method, combined with time, creates compounding growth that accelerates as the years pass. What's remarkable is how this approach reduces stress. By focusing on long-term security instead of short-term wins, Swiss bankers remove the emotional roller coaster from money management. They don't lie awake worrying about daily market swings because their strategy isn't built on timing or luck. It's built on patience and persistence. The lesson here is clear. If you want to invest like a Swiss banker, adopt long-term discipline. Stop chasing fast money. Stop panicking at every dip, and stop jumping from one trend to the next. Instead, build a consistent plan, stick to it, and let time work in your favor. Swiss bankers know the secret that many overlook. Real wealth isn't built in a year. It's built over decades, and the patience to wait is what makes their money last. If there's one thing Swiss bankers are known for more than anything else, it's discretion. For centuries, Switzerland built its reputation as the safest place on earth to keep money, not just because of stability and security, but because of privacy. And this value of discretion doesn't only apply to billionaires hiding fortunes. It shapes how Swiss bankers themselves handle their own money, investments, and lifestyles. In Switzerland, wealth is meant to be private. Unlike in many cultures where showing off is celebrated, flaunting success is considered distasteful. That's why you don't often see Swiss bankers driving flashy sports cars, wearing extravagant jewelry, or broadcasting their salaries. Instead, they keep their financial lives under the radar. Their cars are practical, their homes are comfortable, but not ostentatious, and their spending choices don't draw unnecessary attention. This discretion serves a practical purpose. It prevents social pressure. When you don't know how much your neighbor earns or what your colleague has invested in, you don't feel the need to compete. Privacy eliminates the cycle of overspending just to keep up. For bankers, this cultural habit allows them to save and invest without the distractions of status games. In their professional world, confidentiality is everything. A Swiss banker's reputation depends on their ability to protect client information. That mindset carries into their personal finances too. They don't brag about investment wins, they don't broadcast what assets they hold, and they certainly don't share every detail of their financial plans. This secrecy isn't about hiding wealth from others. It's about protecting it from risk, judgment, and unnecessary exposure. Even the way they structure their investments reflects discretion. Swiss bankers favor financial setups that are secure and low profile. Trusts, diversified funds, or real assets like property are chosen not just for stability, but also for the quiet way they preserve value without drawing attention. In many cases, their goal isn't to be seen as wealthy, but to feel secure privately. This philosophy extends to family as well. Swiss parents rarely spoil children with visible luxuries. Instead, they quietly fund education, support savings accounts, and pass down financial wisdom. The wealth transfer happens discreetly, with the emphasis on stability and preparation, rather than status symbols. That privacy protects both the family's reputation and the next generation's ability to manage money responsibly. For the rest of us, there's a powerful takeaway. Wealth doesn't need to be loud. In fact, the quieter your money is, the safer it usually becomes. By keeping financial details private, you reduce the risk of envy, theft, and even your own impulse to overspend. Living modestly doesn't just protect your bank account, it strengthens your discipline. Swiss bankers prove that discretion isn't about secrecy for its own sake. It's about control, focus, and freedom. By keeping money matters private and living below the radar, they ensure that wealth remains a tool for security, not a performance for others. And that's a lesson anyone can apply, no matter how big or small their paycheck. Swiss bankers have built their reputation on protecting wealth, and the way they manage their own money shows us why. They diversify across assets, put safety before risk, lean on real and tangible value, stay disciplined for the long run, and keep their financial lives private. None of these habits are flashy. And that's the point. Quiet, steady strategies are what preserve wealth not just for a lifetime, but for generations. And here's the best part. You don't need to be a banker in Zurich to apply these lessons. Whether it's spreading your investments, avoiding risky debt, or simply living more privately, anyone can bring a bit of the Swiss banker mindset into their own life. So tell me, which of these strategies would you try first? Drop it in the comments, and don't forget to like and subscribe for more money secrets from around the world.